Let's connect with Adrian Mowat, Chief Emerging Market and Asia Equity Strategist with JPMorgan. He joins us live from Hong Kong. Adrian, appreciate your time. Thank you for joining us. It's a big day for us. ET Now, India's #1 channel, has turned 5 today.
Well, happy birthday to everyone at ET Now.
Well, Adrian, really appreciate your time. And before I throw my first question at you, I want to thank you for all your support. We wouldn't have reached where we've reached without your support and without your endorsement. But Adrian, my first question to you is that how important is Iraq? For the moment, everyone is of the view that geopolitical concerns really could have a big impact on emerging markets and on developed markets.
Yeah, I think Iraq is probably exaggerated in its importance in the way it's being covered at the moment. Iraq produces about 3% of global oil supply. The areas of the current unrest are not major oil-producing areas. So I think the real impact on the flow of oil is going to prove to be quite modest. And I'm sure that's why the oil price has moved to a slightly higher range, but the move looks reasonably modest.
Adrian, we've had a fabulous run here in India, but off late we seem to have gotten in somewhat of a lean period in the run-up to the budget. What's the sense that you're getting? How much more upside can the equity markets see from here onwards? And do you think it's now a budget which is going to push the market higher if it has to?
Well, let's not forget that the second half of last year was a rather troubled period for Indian equities. So part of the move you've seen in this market has been a recovery from the fears around tapering, the weakness we were seeing in the currency last year. So we've had a recovery from that, and we've also had an election result that was much better than anyone had really hoped for. And I think there's a lot of reasons to be optimistic about the Indian economy as we travel through the balance of 2014, move into 2015. You've got a clear movement up in consumer confidence, business confidence. I think you're going to see corporate capex pick up, and hopefully you're going to see some announcements out of this government that allow public sector investment to improve, and that's all going to be against a very easy base in the second half of 2013.
Adrian, stock prices and real economy, they never go hand in hand. What we've seen up until now is a massive stock readjustment, a massive appreciation in economy-related stocks. Do you think in the short term valuations are looking slightly stretched, or valuations will look slightly stretched because we are going through a big change in India?
No. If you look at the P multiples of the market, I look at MSCI India, it's at its 10-year average. The price to book is a little bit below its 10-year average. When we think about the conditions in India, you're coming off a cyclical low, so earnings are depressed. If we look at cyclical stocks in India on a 5-year chart, you get a very different impression than you do looking at the 6-month chart. Many cyclicals are way below their 5-year highs. And so it does not worry me that the market has moved sharply from its lows in the last 6 months. I think that's a well-deserved move. Valuations are fine. And my advice to investors is stick with this market. You're going into a phase of positive economic data versus expectations and positive earnings data versus expectations.
Adrian, if I look at India's relative performance versus the other emerging markets, India has done exceptionally well. In fact, according to the recent data which we've got from various brokerages, India has got lion's share of inflows also when it comes to emerging markets. Do you think India is a crowded trade, or given the kind of change what Indian economy could see, India is a crowded trade and it will remain a crowded trade?
Well, I think you need to build this up from different layers. So if you look at emerging market mandates, then yes, they are overweight India. The bulk of the funds that we look at are overweight India. However, global funds are underweight emerging markets. Retail investors, up until very recently, have been redeeming both ETFs as well as actively managed mutual funds. We're now seeing a slow return to those open-ended products, and we're also gradually finding that the global asset allocators starting to look at EM once again. And so I think, yes, India may be a popular overweight, which is for very good reasons. It's working well. But if you think about the flows as the global investor allocates back towards EM, then India will continue to receive inflows. I would also caution people on this. India gets a disproportionate amount of the flow. Remember that there are only a few markets where you get high-frequency exchange data on inflows. So those would be places like India, Taiwan, Korea. We don't get this information for the Hong Kong, China market. We don't get it for any of the ASEAN markets. And so when I look at that statistic, it's normally misrepresenting what's going on.
Adrian, what's the view then on Indian IT? Because while the markets went off to an all-time high, you saw IT take a backseat, and again this sector is in focus. Very positive commentary coming in from TCS over the weekend, and now a new CEO, the SAP ex-head coming in and taking over at Infosys.
I think you just spoil for choice in India. My bias if I was running just a pure Indian portfolio would probably be to underweight the exporters as they are more defensive and be overweight domestic cyclicals. But when I look at this from a perspective of a global investor, I am very bullish on the U.S. economy, which is the key market for the Indian IT companies. I think we've probably seen the most of the rupee strength. And this sector looks interesting, but so do the cyclical sectors, so do the near cyclicals like the banks. Maybe the only thing that isn't interesting is the consumer staple companies.
Adrian, but do you think the secular rally in Indian cyclical stocks is getting over? Up until now, it's been a rising tide and everything has gone up in a synchronized manner. Do you think it's now time to be much more stock specific? Everything in the economy will not do well. There are pockets of stress and there are pockets of opportunities.
Well, I mean, it's a truism that you should be stock specific. There are good and bad quality companies. Although, if you think about a turning economy, you're probably better off in the company with a bad balance sheet and low margins because they tend to get the biggest lift as economies turn. So often what you find is that the client's portfolios are too high quality to outperform the market at these stages. So our advice to clients is maybe be stock specific, but try and lower the quality of your portfolio rather than sticking with the blue chips.
What is your take on industrials? The fortunes of the industrial sector are completely related to a capex cycle. And in India, capex cycle is not the need of the hour.
Well, I'm not sure if I agree with that statement. I mean, if you look at the weakness in the Indian economy, much of that has been a very weak story in capex, both public and private sector. India does have a significant power deficit. It does need to build more infrastructure in many areas. And the corporate sector, as demand picks up, is going to need to invest. So I think that the types of runs that we've seen in the engineering and construction stocks are understandable. And they probably will continue if we start to see orders being given out to these companies, which tends to be the main driver of the share price rather than valuation.
So going by the Sensex or the Nifty, Adrian, how much more upside do you see now from these levels, and what is your year-end target?
Yeah, we don't have a formal year-end target. I have a year-end target for the emerging market index, which is a return of about another 15%. I think India will outperform that, so maybe that gives you some guidance in the sort of magnitude of returns that I'm expecting.
Adrian, if the economy comes back along with economy-related themes and groups, consumer demand will also make a comeback. So what is the best way to bet on India demographics? Staples are expensive, but what is the other entry point to bet on consumption?
Well, I think you look at domestic two-wheelers, domestic auto companies as the most liquid way of playing consumer discretionary in India. And you underweight the consumer staples.
So, Adrian, from someone who's been a keen observer of India and sitting outside the country, What is it that the markets would like to see from this time's budget? Because going by Narendra Modi's body language, one can tell it is going to be a hawkish sort of budget that we'll see next month, and not as many freebies as the markets would like.
Yes, I mean, I think positioning this budget is quite interesting because we're still in a degree of electioneering in India ahead of state elections. But, you know, if I wanted to answer the question just purely from a market perspective, I would actually like a tough budget when it comes to reductions in subsidies. I would like to see him endorsing the ID card, which up to now he's been, less keen on, because I think that's a very important part of reducing subsidies in order to get direct cash payments to those in need. And at the other side, I don't want him to cut the fiscal deficit. I'd like the government to spend more on infrastructure. So if we can deal with the structural issues, which is the fiscal deficit driven by large subsidies, and move that deficit into a deficit that's about investing in the future, then the market would welcome a budget like that.
Adrian, final question. Are we getting slightly blindfolded with global cues, be it Iraq, be it geopolitical concerns, be it Europe or US? As of now, we've seen a drop in volatility and uneasy calm in global equities, but you never know what is in store in the second half.
Well, you know, the problem with surprises is we don't know them. So, you know, you're right, markets are at a high level. Realized vol is very low, and that's part of the reason that we're driving the implied vols in the option markets down. But I'm not entirely sure I'd agree that investors are, particularly complacent. When I interact with clients, they have many questions which suggest they're cautious, they are worried about things, that their confidence in growth has been diminished by the weak first quarter. So I'm reasonably confident that we're going to see data points which continue to support markets. And we've also got a broadening of what we call the axis of easing. The Europeans have joined that. We obviously have the Japanese there. We've got a cut in interest rates in a number of the key emerging markets, particularly those in Mexico and in Turkey, surprising us. And I also think the conversation around the Reserve Bank of India has moved from when will they increase interest rates to some speculation that they might be easing policy. So I think there's a lot of good news out there, and that's why markets have been doing well.